Let me tell you something that most financial analysts are getting completely wrong right now. They see China selling U.S. Treasury bonds. They see the yuan internationalization push. They see the Shanghai Gold Exchange gaining volume, and they assume this is all about displacing the dollar as the world's reserve currency. And look, on the surface, that logic makes total sense. Why wouldn't China want to dethrone the dollar? It's the ultimate geopolitical prize, the foundation of American financial power. But here's where it gets interesting, and honestly, this completely flipped my understanding of what China is actually doing. China doesn't need to replace the dollar to destroy it. They just need to make it optional. And that optionality, that ability for major economies to transact outside the dollar system even part of the time, that's the weapon. And it just got activated in a way that most people aren't fully processing yet. Stay with me here, because what happened in the last 18 months represents something genuinely unprecedented in modern financial architecture. For the first time since 1974, when the petrodollar system crystallized, major oil-producing nations are accepting payment for energy in currencies other than dollars. Saudi Arabia, the linchpin of the entire petrodollar mechanism, let its 50-year exclusive dollar agreement with the United States quietly expire. The UAE is settling oil trades in yuan. Russia is demanding rubles or gold from unfriendly nations. Iran has been conducting oil sales in yuan for years. This isn't theory anymore. This isn't some future scenario. The infrastructure for dollar-optional energy trade is operational right now. And the fascinating thing, the part that reveals this is a deliberate strategy rather than chaotic reaction, is that China isn't demanding every transaction run through yuan. They're not trying to make the renminbi the new global reserve currency. Anyone who understands how reserve currencies actually function knows that requires capital account openness, deep liquid bond markets, and rule of law that inspires confidence in foreign holders of your debt. China has none of those things, and Beijing shows zero interest in developing them, because that's not the play. The play is creating parallel infrastructure that makes dollar dependency optional for critical transactions. Once optionality exists, the monopoly unravels. Not overnight, not through dramatic collapse, through steady erosion as more actors realize they don't have to play by rules designed in Washington. To understand why this optionality functions as a weapon, you have to think about what the dollar system actually represents. And I mean really think through the architecture, not just accept the simplified version we all learned. The dollar isn't just a currency. It's a surveillance system, a sanctions enforcement mechanism, and a subsidy transfer system all wrapped into one. Every international dollar transaction eventually clears through New York. Every wire transfer touches SWIFT or a correspondent banking relationship ultimately traceable to American financial institutions. This gives Washington visibility into global financial flows and the ability to cut actors out of the system entirely through sanctions. That visibility and control enabled the most sophisticated financial warfare campaign in history. When the United States froze Russia's $300 billion in foreign exchange reserves in 2022, something shifted in the strategic calculations of every government on Earth. It wasn't just the scale, it was the precedent. If Washington could immobilize the central bank reserves of a nuclear-armed permanent UN Security Council member over a regional conflict, what constraints actually exist on American financial power? The answer that echoed through capitals from Beijing to Riyadh to New Delhi was simple: none. The only constraint is Washington's discretion. And discretion isn't a system, it's a risk. Think about what that means if you're managing a sovereign wealth fund or a central bank in a country that might someday find itself in Washington's crosshairs. You're holding assets denominated in a currency controlled by a foreign government that has demonstrated willingness to weaponize access to the financial system. Your reserves, the buffer that's supposed to protect your economy during crisis, could vanish with a single executive order. Not through market crash, not through inflation, through political decree. That's not theoretical risk, that's demonstrated capability. Now here's where China's strategy becomes genuinely sophisticated, where you see evidence of patient systems thinking rather than reactive policy. China watched what happened to Russia and recognized an opportunity. Not to attack the dollar directly, which would trigger immediate American response and global financial instability that hurts everyone, including China, but to offer an exit ramp, to build infrastructure that allows other countries to reduce their dollar dependency gradually, voluntarily, in ways that serve their own interests rather than Beijing's explicit geopolitical goals. This is what I call the optionality framework. And once you understand how it operates, you start seeing it everywhere in China's recent recent financial architecture development. The framework works like this. You don't need to replace the dominant system to undermine it. You just need to create viable alternatives for specific high-value transactions. Once those alternatives exist and prove functional, more actors adopt them. Each adoption makes the alternative more liquid, more trusted, more valuable. The network effects that built the dollar system now work in reverse. Not through destruction, through substitution. Let me walk you through exactly how this infrastructure actually functions, because the architecture is genuinely elegant in its simplicity. The Cross-Border Interbank Payment System, CIPS, China's alternative to SWIFT, processed about $12 trillion worth of transactions last year. That's roughly double the volume from 3 years ago. CIPS now connects over 1,300 financial institutions across more than 100 countries. When a bank in Pakistan wants to pay for Chinese imports in yuan, they route through CIPS. When Brazil and China conduct their bilateral trade settlement, CIPS handles the clearing. The system works. It's not as deep or as liquid as SWIFT, not remotely close, but it doesn't need to be. It just needs to work reliably for the transactions it handles. Then you layer on the digital yuan. The ECNY represents the most advanced central bank digital currency in operational deployment. China has conducted trials involving hundreds of millions of people and billions of dollars in transactions. The digital yuan allows direct peer-to-peer transfers without correspondent banking relationships. Think about what that means for cross-border trade. A factory in Vietnam can pay a supplier in Guangdong directly, wallet to wallet, no intermediary banks, no dollar conversion, no SWIFT messaging, no New York clearing. The transaction completes in seconds, costs nearly nothing in fees, and generates no data accessible to American intelligence services. Now add the Shanghai Gold Exchange and the Petro-Yuan contracts. China is the world's largest gold importer, and the Shanghai Exchange has quietly become the second largest physical gold trading hub after London. Here's why that matters. Gold functions as a non-dollar settlement mechanism for international imbalances. If Saudi Arabia sells oil to China for yuan, but doesn't want to hold large yuan positions long-term, they can convert yuan to gold on the Shanghai Exchange, then sell that gold anywhere in the world for whatever currency they prefer. Gold becomes the bridge asset that makes yuan-denominated oil trades viable, even for sellers who don't trust Chinese currency. The Petro-Yuan futures contracts launched in Shanghai allow oil pricing in yuan with settlement optionality in either currency or gold. The volume has grown from essentially zero in 2018 to over $15 billion daily now. That's still tiny compared to Brent or WTI crude benchmarks, but it's functional. It provides a mechanism, and mechanisms expand once they prove they work. Let me give you a concrete scenario for how this operates in practice, because the abstract description doesn't capture the strategic elegance. Imagine you're the finance minister of a middle-income country. You import significant amounts of Chinese manufactured goods, machinery, electronics, construction materials. You export agricultural commodities and raw materials to various markets, including China. Under the dollar system, every transaction requires conversion to dollars, even when both parties are non-American. You buy yuan with dollars to pay Chinese exporters. Chinese buyers purchase dollars with yuan to pay for your commodities. Banks collect fees on each conversion. Every transaction generates data visible to American surveillance. And you hold dollar reserves as a buffer, accepting the risk that Washington might freeze them if your government makes policy choices America dislikes. Now China offers you an alternative. Set up a yuan clearing bank in your capital. Conduct bilateral trade in yuan directly. Chinese importers pay your exporters in yuan. Your importers pay Chinese exporters in yuan. Balances settle through periodic transfers, not individual transactions. The transaction costs drop by 60 to 70%. Settlement happens in hours instead of days, and critically, the entire flow bypasses the dollar system entirely. No conversion, no correspondent banking, no SWIFT, no New York, no Washington visibility. You don't need to trust China more than you trust America to accept this arrangement. You just need to assess that the efficiency gains and reduced political risk outweigh any new dependencies. And for more and more countries, especially those in the global south that have watched Washington weaponize the dollar repeatedly, that calculation is shifting. Not because they love China, because they hate dependency. Here's another factor that makes this particularly significant for American strategic planners. The countries most aggressively adopting yuan settlement are resource exporters: oil, natural gas, minerals, agricultural commodities, the actual physical stuff that the global economy runs on. When resource flows start denominating in non-dollar currencies, something fundamental breaks in the petrodollar architecture. Remember, that system wasn't just about oil transactions happening in dollars, it was about creating structural global demand for dollars that allowed the United States to run permanent trade deficits, permanent fiscal deficits, and permanent current account deficits without currency collapse. The mechanism worked like this. Global economy needs energy. Energy trades in dollars. Therefore, global economy needs dollars. Therefore, central banks hold dollar reserves. Therefore, demand exists for U.S. Treasury bonds. Therefore, Washington can borrow cheaply to fund government spending and military presence that protects the oil trade that creates the dollar demand. Every component reinforced the others. It was the most elegant imperial financing mechanism ever constructed, but it required universal participation. Once major energy flows started transacting outside dollars, the demand structure fractures. Let me give you some specific numbers that reveal the scale of what's shifting. In 2020, roughly 87% of international transactions denominated in dollars. By the end of 2024, that figure dropped to just under 80%. 7 percentage points might sound trivial, but consider that this represents transactions worth trillions of dollars annually moving outside the dollar system. More importantly, the velocity of that shift is accelerating. The decline from 90% to 87% took a decade. The decline from 87 to 80 took 4 years. If the current trajectory continues, and there's no obvious force that would reverse it, dollar share of global transactions could drop below 70% within 5 years. At what point does reduced dollar demand start creating serious problems for American fiscal sustainability? The United States currently carries $36 trillion in federal debt. That debt remains serviceable because Treasury bond yields stay relatively low due to sustained global demand. But that demand assumes dollars remain necessary for international commerce. If countries need fewer dollars for trade, they need fewer Treasury bonds as reserves. Reduced demand for treasuries means higher yields to attract buyers. Higher yields mean exploded debt service costs. The Congressional Budget Office projects debt service consuming nearly 15% of the federal budget within a decade, even at current rates. If rates rise another 200 basis points due to reduced foreign demand, debt service could approach 25% of federal spending. Think about what happens when a quarter of the federal budget goes to interest payments rather than programs, defense spending, or infrastructure. That's not a sustainable fiscal position. It's a debt spiral. And the only ways out are massive spending cuts, massive tax increases, or inflation through monetary expansion. Each option carries severe political and economic consequences. China doesn't need to destroy the dollar to win this competition. They just need to make it expensive for America to maintain the system. And expensive it's becoming. Now add to this something that makes the timeline particularly compressed. The Federal Reserve's balance sheet expansion during COVID added roughly $5 trillion to global dollar supply through quantitative easing. Those dollars circulated through the international system, and many ended up as reserves in foreign central banks. As the Fed attempts to reduce the balance sheet through quantitative tightening, they're pulling dollar liquidity out of the global system. Less dollar liquidity makes dollar scarcity more acute. Dollar scarcity makes alternative settlement systems more attractive. It's a feedback loop that accelerates de-dollarization even without Chinese intervention. Let's talk about what this means at the tactical level first, for the actors immediately involved. For China, the ability to conduct trade in yuan reduces their vulnerability to sanctions and provides leverage in bilateral relationships. Countries that adopt yuan settlement develop dependency on Chinese financial infrastructure, creating political influence that doesn't require military presence or explicit coercion. It's soft power through financial plumbing. For American allies in Europe and Asia, the situation creates genuine dilemma. They benefit enormously from the dollar system and maintain deep integration with American financial markets. But they also recognize that total dollar dependency creates vulnerability. What if Washington freezes their reserves over a policy disagreement? What if American domestic politics produces a government that weaponizes financial access against traditional partners? The rational response is to develop optionality even while maintaining primary dollar relationships. And that optionality, once developed, becomes infrastructure that can expand. For oil-producing nations in the Middle East, the new architecture offers leverage they haven't possessed since the 1970s. For 50 years, Saudi Arabia's security relationship with the United States rested partially on petrodollar recycling. Riyadh sells oil for dollars, uses those dollars to buy American weapons and treasury bonds, and receives security guarantees in return. But what if Riyadh can sell oil for yuan to China, its largest customer, while still maintaining the dollar relationship with smaller buyers? Suddenly, the monopoly breaks. Saudi Arabia gains negotiating leverage with both Washington and Beijing. At the regional level, you're seeing entire trade blocs beginning to explore dollar alternatives. The BRICS nations, representing roughly 40% of global population and 30% of global GDP, have discussed creating a common settlement currency for intra-bloc trade. ASEAN countries are expanding local currency settlement mechanisms. The Shanghai Cooperation Organization is developing yuan-based trade frameworks. None of these initiatives have reached the scale that threatens dollar dominance independently, but collectively they represent infrastructure development that makes dollar-optional trade increasingly feasible. Here's where it connects to global economic stability in ways that should genuinely concern policymakers in every major economy. The dollar system, for all its flaws, provided a stable unit of account for international trade. Commodity prices denominated in dollars, exchange rates pegged to dollars, debt issued in dollars. This created predictability. When multiple currency blocks start forming, each with its own settlement systems, price discovery becomes fragmented. Is copper worth $6,000 per ton, or 35,000 yuan, or 4,000 euros? The exchange rates between these currency zones fluctuate, creating volatility in real prices even when supply and demand fundamentals haven't changed. That volatility makes long-term contracts harder to negotiate, supply chain planning less reliable, and corporate profit forecasting more uncertain. Uncertainty reduces investment. Reduced investment slows growth. This is not a recipe for global prosperity. It's a recipe for fragmentation, inefficiency, and recurring crises as capital flows between currency zones create destabilizing surges and crashes. The multipolar currency world might serve various nations' geopolitical interests, but it's economically inferior to a stable, single currency system. Now zoom out to the structural level, to what this means for international order itself. The dollar system wasn't just financial infrastructure, it was governance infrastructure. It gave Washington enormous influence over global economic rules and enforcement mechanisms. Countries that wanted access to dollar clearing had to comply with American sanctions, anti-money laundering standards, and financial regulations. This created de facto American jurisdiction over much of the global economy. As that jurisdiction fragments, so does the ability to enforce coordinated action on anything from climate finance to counterterrorism to pandemic response. If major economies operate in separate financial spheres, coordinating policy becomes vastly more complex. You can't sanction a country that doesn't use your financial system. You can't enforce a deal if the counterparty can exit into alternative infrastructure. The result is not multipolar order, it's declining order. Fragmentation, competition, and the return of spheres of influence not seen since before World War II. These trends aren't happening in separate boxes, they interact. Financial fragmentation generates political tension. Political tension makes financial cooperation harder. Harder cooperation accelerates the search for alternative systems. Alternative systems deepen the fragmentation. The cycle reinforces itself. And critically, it reinforces itself even if every actor involved would prefer the stability of the previous system. This is structural trap, not deliberate conspiracy. China didn't set out to destroy the international financial architecture. They set out to protect themselves from American financial coercion. The architecture is collapsing as a side effect. So when you zoom all the way out and look at the complete picture, what you see is not a dramatic currency war where the yuan suddenly replaces the dollar as supreme global reserve currency. What you see is something more subtle and potentially more destructive. The slow motion fragmentation of the global financial commons, the replacement of a unified dollar-based system with multiple overlapping currency zones, each offering optionality that undermines the stability that made the original system functional. China activated this weapon not through aggressive attack, but through patient infrastructure development. They built alternatives. They made them work. They offered them to countries that had reasons to worry about dollar dependency. And those countries, acting rationally in their own interests, began adopting the alternatives. Each adoption weakened the network effects that sustained dollar dominance. And network effects, once they start reversing, are almost impossible to stop without addressing the underlying reasons people are exiting the network in the first place. The real question is not whether the dollar remains the world's primary reserve currency. The dollar will likely maintain that position for years, possibly decades. The question is whether that position still provides the strategic advantages it did when dollar transactions were effectively mandatory for international commerce. When alternatives exist, when major flows of oil and commodities and manufactured goods start transacting in yuan or euros or digital currencies, when the option to exit the dollar system becomes credible, the monopoly breaks. And American fiscal sustainability, military presence funding, and geopolitical leverage all rest on that monopoly continuing. The United States can't reverse this trend through financial policy alone. The fundamental problem is political. Washington weaponized the dollar system. That weaponization created demand for alternatives. The alternatives now exist and function. Trying to suppress them through sanctions or pressure just validates the concerns that drove their creation. It's a trap built not through Chinese manipulation, but through American overreach. And right now, the conditions for acceleration are assembling faster than the conditions that might arrest the decay. So the next time you see headlines about treasury bond sales, or yuan internationalization, or gold reserve accumulation, try holding all of these pieces together in the same frame, because they're not separate stories about currency competition. They're different angles on the same structural transformation. The slow unwinding of the financial architecture that funded American primacy for half a century. And that unwinding doesn't require the dollar to collapse. It just requires the dollar to become optional, which, if you're paying attention, it already has.